On March 24, 2026, the UK's business world faces a sharp slowdown after months of modest growth. The cause? A new conflict in the Middle East, with war erupting in Iran just last month. This instability has sent shockwaves through the global economy, stalling the momentum British businesses had built since last September. Companies of all sizes now face rising risks and uncertainty, forcing them to rethink their plans. The conflict has disrupted global trade, making goods more expensive and harder to move. Costs for British companies are surging at a pace unseen in years, directly impacting consumers and workers. This is a vivid reminder of how interconnected our world is. Distant conflicts can quickly affect our jobs and prices at home. The economic ecosystem is fragile, and the Middle East crisis is sending waves across the UK. To understand this slowdown, we must examine how the conflict is driving up costs and reshaping business expectations. The story is complex, but its impact on our daily lives is impossible to ignore. To gauge economic health, experts turn to the Purchasing Managers' Index, or PMI. This index surveys business managers about new orders, production, employment, and supply times, offering a real-time snapshot of growth or contraction. A PMI above 50 signals expansion. Below 50 means contraction. In February, the UK's composite PMI was a healthy 53.7, but March's preliminary reading plunged to 51.0. While still above 50, this is the weakest business activity since September 2025, a sharp and sudden slowdown. The drop shows businesses are growing at a much slower pace, with momentum lost. The PMI acts as an early warning system, signaling a shift in the economic environment. March's sharp fall confirms fears that the Iran conflict would have real consequences for the UK. The impact is already visible in order books and production plans. The PMI's decline is the first clear statistical evidence of the economic storm now gathering. It's a wake-up call for policymakers and businesses alike. The war in Iran has disrupted global supply chains, especially vital oil and gas routes. Shipping lanes are now riskier and more expensive, driving up insurance and forcing ships onto longer routes. The most immediate effect is soaring fuel prices. Crude oil has spiked on global markets. For the UK, which relies on imported energy, this means higher costs for homes, vehicles, and factories. Petrol and diesel prices are rising, hitting drivers and businesses alike. Transport costs have surged, and logistics companies are passing these increases down the line. Every business that moves goods now faces higher bills, making nearly every product more expensive. Energy-intensive raw materials like steel and plastics have also become pricier. British manufacturers are squeezed as their basic components cost more. The ripple effect is clear. From car parts to construction, the cost of making almost everything is rising. Higher fuel, transport, and raw material prices have created a perfect storm for UK businesses. The PMI survey shows input prices for manufacturers jumped from 56.0 in February to 70.2 in March, the biggest monthly surge since 1992's sterling crisis. This is not a minor fluctuation, it's a major economic shock. Businesses now face soaring costs for energy, deliveries, and materials, squeezing already thin profit margins. Many must choose between absorbing these costs or passing them on to customers. For smaller firms, absorbing such increases is often unsustainable and threatens their survival. The pressure isn't limited to manufacturers. Service industries also face higher energy and transport bills. The entire business community is grappling with a new reality. The cost of doing business in the UK has jumped dramatically in a matter of weeks. Companies are being forced into tough decisions about pricing, staffing, and investment. The shock is testing the resilience of businesses across every sector. The scale of this cost surge is unprecedented in recent memory. The UK economy is under severe strain. With costs soaring, UK businesses are raising prices to survive. The latest data shows selling prices are increasing at the fastest rate since April 2025. This is a direct response to supply chain pressures triggered by the Iran conflict. From bakers to builders to taxi firms, higher input costs are being passed on to consumers. This chain reaction is fueling inflation, the general rise in prices that erodes purchasing power. Households now find their budgets stretched thinner, with the cost of living rising sharply. Companies cite the Middle East conflict as the main driver behind these price hikes and the heightened sense of risk. Raising prices is a defensive move, but collectively it creates a new inflationary challenge for the nation. The money in people's pockets simply doesn't go as far as it did. Inflation is now a pressing concern for every household and business. Surging inflation puts the Bank of England in a tough spot. Its job is to keep inflation near 2%, usually by raising interest rates. But with the economy already slowing, higher rates risk tipping the UK into recession. The bank recently held rates steady, choosing caution as it watches the situation unfold. It has revised its inflation forecast upward, now expecting inflation to reach 3.5% by mid-year. This is a clear sign that the economic landscape has changed dramatically. The UK now faces a stagflationary shock, slow growth, combined with high inflation. Central bankers must balance fighting inflation with avoiding deeper economic pain. Every move will have major consequences for mortgages, loans, and the broader economy. The bank's next steps are critical and uncertain. The nation is watching closely. The slowdown and rising costs are hitting jobs and business confidence hard. The PMI shows UK employment has fallen for the 18th straight month, the longest decline since the 2010 financial crisis. Even before the Iran shock, the job market was fragile. Now, the outlook is even bleaker. Businesses facing weak demand and squeezed profits are cutting staff or freezing hiring. Business expectations for future growth have dropped to their lowest since June 2025. This pessimism can become self-fulfilling, as cautious firms invest and hire less. The combination of falling employment and declining confidence paints a somber picture. Workers face a tougher job market and greater uncertainty. The human cost of this slowdown is becoming painfully clear. The Eurozone faces similar shocks from the Iran conflict, but the UK's slowdown is sharper. While the Eurozone's PMI dipped only slightly in March, the UK's fell much more steeply. This suggests the British economy is more vulnerable to these pressures, or had less momentum to begin with. The UK's economic structure and reliance on certain imports may be factors. Domestic challenges have left the UK more exposed to this external shock. This isn't a competition, but it highlights how unevenly the crisis is hitting Europe. The UK's tougher experience may shape future government and Bank of England decisions. Understanding these differences is key to crafting an effective response. As March 2026 ends, the UK faces a future clouded by uncertainty. Business growth has slowed, costs are soaring, and inflation is rising. These are not short-term problems. The government is preparing for a prolonged crisis, with no quick return to normal in sight. Businesses and households must adapt to ongoing supply disruptions and high prices. The Bank of England faces the daunting task of controlling inflation without derailing the economy. Companies must manage rising costs and weaker demand. Households face a tougher job market and higher living expenses. There are no easy solutions. Global events are shaping our economic reality. The economic ecosystem has been shaken, and aftershocks will continue for months. The slowdown is a warning. The climate has fundamentally changed. Navigating this storm will require resilience, patience, and clear-eyed planning.